Junior Achievement of Greater Cleveland and Citizens Bank presents JA Personal Finance, Session 4, Credit and Debt.
Welcome back. It's Nadata Letson at Citizens Bank. So today we're going to talk about credit and debt. In this session, we'll investigate the types of credit and their cost and benefits. Most people will need some form of credit at some point in their lives, and not all credit resources are bad. In fact, using credit wisely to establish a good credit score can work to your benefit. Also, some credit resources offer incentives that can help you save money. And if you don't believe me, ask a couple of my friends. I brought them with me today.
Hi, my name is Alan Blumenthal. I'm a proud Cleveland Heights High School alum, class of 1982. I do remember sitting in a junior achievement class when I was in my junior or senior year, and even went on a field trip to go visit a business. And I always thought I wanted to go into business. I had no idea what I wanted to do. I certainly didn't know I wanted to work in a bank. Along the way, I went to Indiana University. I got a business degree. Still didn't necessarily know I wanted to work at a bank. Took a job in a bank as a financial analyst and learned what banking was all about. So in a lot of ways, you don't really learn about a bank until you work at a bank. But today we're here to talk about just simple credits and debits. I am a senior vice president for Citizens Bank. I've worked at KeyBank. I've worked at Chase in similar type groups and at those institutions. And today, I constantly am learning about credit and debits. Credit is in the most basic form, your integrity, your history of payment. When you get a loan, credit card or otherwise, there's the most important thing in the documentation. There's all kinds of legal stuff that's involved, but you are promising to pay. So how well do you pay? And the most important thing that you will hopefully hear me say today is to make the minimum payment on your credit card and certainly on any kind of car loan or house loan later in life. That is the most important thing. And as long as you make the minimum payment, you will get a decent credit rating without getting into all the gobbledygook and all the details behind it. It's a very simple thing. You make every payment you're asked to on time, you'll have a decent credit rating. And later in life, when you go for a car loan, a home loan, whatever it is, you'll pay less in your payments because you'll get a lower interest rate. That's the most important thing. If you don't hear anything else, that's what the message is today. Going beyond that, you should try to not use a credit card for anything that you can't pay off within a short period of time. And if you make the whole payment, your credit rating will be even better. There's other things that are involved with a credit rating, how much debt you have for how much you make. But let's just try to make today's discussion as simple as possible. Let's just talk a little bit about how the process works. You get a new credit card, and if you haven't already noticed, you'll get a ton of applications in the mail. Banks make an enormous amount of money on credit cards. The secret that probably the senior management doesn't want us telling you is how much money we make off of credit cards. And it's because people misuse their credit cards and they keep balances and they pay high rates of interest that they probably shouldn't be paying. So when you get your first credit, when you get any credit card, you make a purchase. So let's just say you purchase an item for $100. And then you get a bill, you get an invoice 25 days later, approximately, but it depends where you are in your cycle. Sometimes it can be shorter than that. And you owe $100 and your minimum payment is, let's just say, $20. So you should make your minimum payment, as I said before, but you really should pay the whole thing off, because if you don't, you will pay interest from the day on the amount that you didn't pay. You will pay interest from the day you made the purchase. So that can really add up, especially if you continue to just make minimum payments. Again, you should at least make minimum payments, but you're much better off not using the credit card unless you can make the payment. Use a debit card, which will get you some of the advantages of not carrying cash. And, it will come directly out of your checking account if that's what you use, a debit card, but you won't pay all that interest. So again, those are the messages that I'm trying to send today. Make a minimum payment and try to pay the whole thing off. You will pay less in interest, you will have good credit ratings, and you'll be a success in life. Good luck. Have a great day.
Hello all, my name is Curtis Faulkner. I'm a branch manager here at Citizens Bank in Ferndale, Michigan. I worked at Citizens for almost 16 years now. I grew up in Detroit where I attended Detroit Public Schools, and I graduated from Cooley High School valedictorian. I have worked with Junior Achievement for several years now, and today I'm excited to do this virtual Junior Achievement session with you guys. I have the honor to talk about credit and debt. Credit is the ability of a customer to obtain goods and services before payment. Debt is money owed or due. These two items play a huge role in our everyday life. A credit score ranges from 300 to 850. 300 to 579 is poor. 580 to 669 is fair. 670 to 739 is considered good. 740 to 799 is considered very good. And 800 to 850 is considered excellent. Your credit score is made up of 5 items. The first one is payment history. This is the biggest portion. It's 35% of your credit score. Payment history means making your payments on time. The next biggest section is credit utilization. That makes up 30% of your credit score. So basically, if you have a credit card and your limit is $1,000, you don't want to max that credit card out. Most credit card companies want to see you only use about 33% of that credit card. So about $330, or to round it off, $350. The next section, credit history length. It makes up about 15% of your credit score. The next one would be credit mix, which is 10%. Credit mix means like credit cards, your mortgage, car notes, personal loans, so the different types of credit. And then the last one would be new credit, is also 10%. So you want to be careful opening up a bunch of different new credit lines or credit cards, things of that sort, because the more credit you open up, it affects the length of your credit history, and it also get hits because you have new credit. Credit is very valuable because it determines how you will live. It affects the amount that you're going to pay for your car, your house, your insurance, and sometimes it even affects the ability to get a job. Why does it affect the ability to get a job? Say if you have a lot of debt out there, then a company such as a bank or a casino may not want to hire you because they feel like you may take their money and pay off your debt. So with that being said, you want to manage your credit while you're young, so when you're ready to make that big purchase, you won't have any issues. So on the flip side, you don't want to acquire a lot of debt. Debt can rack up pretty fast, and it can turn your good credit into bad credit. If you don't have a plan before you make a purchase to pay it off, then don't make that purchase. Without a plan, you can destroy your credit with a lot of debt. With that being said, I want to thank you for your time. Please stay safe and have a great day. Thank you.
That was great. My colleagues gave some excellent tips, especially on how to pay back money you owe when using credit. So let's keep it going. What do you think about this? True or false? Is there no such thing as good debt? True or false? Well, if you said false, then you're absolutely right. Some debt can be good if it's worth more than what you paid for it. For example, a low-interest loan to pay for college or a trade school can pave the way for higher earnings. You might eventually earn more money than you spent on the loan. Let's talk about the objectives of this session. So after completing this session, you'll be able to do 4 things. First, differentiate between credit and debt. Next, recognize the factors that affect an individual's credit score and credit history. Third, recognize the consequences of a low credit score, as well as recognize the impacts of sharing credit cards or co-signing for a loan. Now let's go over a few terms. We have 3 here on the screen: credit, debt, and interest. What do you think these terms mean? Well, let's define them together. How about credit? Credit is the ability to buy goods and services now but pay later. So credit doesn't have to just refer to credit cards. You can also be using credit when you get loans for things like cars, homes, paying for school. And buying on credit means that you have debt or owe money. Now, what about debt, since we've mentioned that? Debt is owing money. Debt includes things like the cost of the item plus interest and maybe fees. And since we mentioned interest can be several things, right? So it's the payment for the use of money, a fee paid to someone for the use of their money, or money earned from allowing someone else to use your money. I kind of like that one better. So interest and fees increase with time. So just remember this: the longer you wait to pay, the more you will have to pay. Well, as you can imagine, there are benefits as well as risks of credit. So let's discuss a few of them. So what do you think some of the benefits are of credit? And how about some of the risks? Let's dig in here. So some of the benefits of having credit is that it allows you to make purchases or large purchases that are difficult to save for. Having credit is convenient, and it's certainly safer than carrying cash. And having credit is really a good thing to have in case of emergencies. And certainly using credit wisely, can build a credit history. And when using it wisely, can build a good credit history. Now, what are some of the risks? So, one of the top risks of having credit is it makes it really easy to make impulse purchases. For instance, you're at the strip mall and you and your friends just decide to stop in a Foot Locker, and the brand new, I don't know, let's say Jordans. Your Jordans just came out. I'm not sure how much they cost these days, but let's just say the ones that you like cost $250. You bought them. Now, you only had $100 in your checking account, right? You didn't really plan on purchasing these, but you did. So it's really easy to make purchases and buy more than you can actually afford. Sometimes terms and conditions are complicated, so you got to read the fine print of all credit offers. And then purchases can end up costing more if they're not paid off on time. So earlier we said that the Jordans cost $250. You have actually $100 in your checking account, so it might take you a little time to pay off that initial $250. The bill comes due, the interest, and you may recall, Alan said you start accruing interest on the day that you purchased it. So the bill comes within a 30-day period, and you only had $100. You probably are not going to use your full $100 to pay off the bill, but guess what? The bill is not $250. Say it's $260. So that's a risk of having credit. Sometimes purchases can end up costing more if it's not paid off on time.
Understanding your credit score, presented by WallStreetSurvivor.com. A credit score is a simple 3-digit number that tells lenders how likely you are to repay a loan. Here are two friends, Leslie and Andy. Leslie and Andy are both 30 years old, living in the same city, working at the same place, and earning the same salary. Leslie is fiscally responsible. She puts a portion of her salary into a savings account every month, always pays her credit card bills on time, and has never missed a payment on the mortgage of her home or her student loans. Andy, on the other hand, is a fiscal mess. Andy lives beyond his means and is always pushing the limit on his credit card, and isn't afraid to miss a payment or two to buy the things he wants. Andy rents an apartment and hasn't even paid off his student loan yet. Now, if both Leslie and Andy came to a banker looking for a loan, which one do you think will get the better rate? Obviously, given their histories, Leslie is more likely to pay back the money she borrows on credit, on time. On the surface, however, Leslie and Andy look pretty similar. Same income, same job, same city. It's only when you dig a little deeper you can get to the good stuff. In order to save time, lenders invented the credit score that takes into account all of your financial history. Banks use your credit score when you apply for any loan, such as a mortgage, a business loan, a line of credit, or car and student loans. Scores typically range from 200 to 850. The higher your score, the better your credit is, and the better rates you'll get. The average score in the United States is around 711. A score of around 740 and above usually gives you the best interest rates, and scores of 620 and below usually prohibit you from borrowing any money at all. A good credit score is important to get good rates on the money that you borrow. For example, given their spending habits, Leslie's credit score would be closer to 850, while Andy's would be closer to 600. If they both need to borrow $1,000, Leslie's interest rate would be closer to 5%, while Andy's could be as high as 20%. So, while Leslie's monthly interest payments would be $50, Andy's would be $200. You can build good credit by getting a credit card as young as possible, paying off your credit card in full every month, sticking with the same credit card for a long time, and never missing a payment on a loan. To learn more about credit reports and other personal finance topics, head over to WallStreetSurvivor.com.
How you handle credit, even as a team, is recorded in your credit history and credit score, which will follow you and affect your future opportunities. Now, it's a risk for lenders to lend money. There's always a chance that money might not get paid back. So a person's credit score gives lenders data that they can really use to decide how much of a risk they're taking by loaning a person money. You can improve a poor credit score by making responsible decisions with your money. Keep in mind, though, it's much easier to keep a good score than it is to repair a low score. Now, recall the factors that affect a credit score? Curtis mentioned them earlier. That's right, payment history, amount owed, length of credit history, types of credit, and new credit. You're absolutely right. Now, besides lenders, there are other people who actually are interested in your credit history. I can think of 4 of them. So who cares about your credit? Insurance companies. So you may pay more for a car or a home or renter's insurance or be denied if your credit is bad. Utility companies. Think about you need electricity, gas, water, a phone or phones, and other utilities, right? So the companies for these type of utilities, they want customers with a history of paying their bills on time. They actually care about your credit. Landlords as well. Landlords use credit reports to screen people with a history of not paying their debts. Landlords typically like to get their rent. And employers, many companies will review your credit report before offering you a job. And your credit report is your reputation. And they're looking for people or clues about folk who, what type of employee you might be. And if you have bad credit, some jobs may exclude you from even applying. And our colleagues mentioned that earlier as well. So, have you ever wondered why there's so many commercials about raising credit scores and repairing credit? Well, let me tell you why. The reason why you see so many of those commercials is because a lot of Americans struggle with their debt. Now, let's determine whether each one of the following tips or statement is a tip for maintaining healthy credit or a common mistake. So let's start with this one here. Using pawn shop loans to get cash instead of using a credit card. Do you think that's a mistake, a common mistake, or a healthy credit tip? Now let's just see. It certainly is a common mistake. How about instead of using credit cards, using payday or installment loans? You're right. That's another common mistake. What about paying your bills on time? Well, we heard a lot about that. That's a good tip. Get as many new credit cards as possible. Now recall, one of the 5 factors, although it's only worth 10%, is new credit. Now, is that this particular statement, is it a common credit mistake or is it a healthy tip? Getting as many new. You're absolutely right. That's a mistake. How about paying the minimum on credit each month? Is that a common mistake or a healthy tip? Not necessarily healthy, right? Because you want to pay more than the minimum so that you get to pay it off. You don't want to incur interest that you don't need to and end up paying more for items than they actually cost. How about buying through rent-to-own programs? Mistake or good tip? You're right. That's a mistake. Using your credit regularly? It's a good idea to do that. How about checking your credit regularly? That's good as well. Now, using student loans to pay for tuition and all your living expenses, since it's low interest, you think that's a good tip or a common mistake? Common mistake? Well, let's see. You're right. What about keep what you owe less than the maximum? Now here we're talking about keeping your balances low on your individual credit lines or credit cards, much lower than the maximum credit limit. Is that a common mistake or a good healthy tip? You're right. That's a good tip. Keep the same accounts open for several years. Well, remember from the video, you want to get started as soon as you can or as early as possible and maintain that credit card or credit line in good standing for as long as you can, right? So keep it open and in good standing for several years. How about always reading the fine print of credit offers? Again, that's a good tip. Great job. Let's review these profiles and credit together. Now imagine you're the lender, reviewing each profile where a person is credit risk. So here's the first one. Is this person a good credit risk? It says, I got my first credit card 1 year ago and I've already maxed it out. I've been making the minimum every month, but I've been a little late a couple times. Well, I've been a little late a couple times. I just got a second credit card for emergencies and I haven't used it yet. Okay, so she has an additional credit with a zero balance. I'm nervous about my credit report, so I haven't requested it yet. Okay, so she's not reviewing her credit regularly. She's already maxed out a credit card a couple times in less than a year. Well, she doesn't have a long credit history, right? And she's been late a couple times. Probably not a good credit risk. At least not at this time. How about this person? Is this person a good credit risk? I recently finished college with $15,000 in student debt. All right. And I started working. I make enough money to cover my student loan and basic expenses, but I've been late on my loan payment a couple times. All right, so he's late on his student loans a couple times. I'm thinking about getting a credit card to free up some spending money in my budget. Well, I'm not sure that he's a good credit risk at this time. How about you? So he's already late a couple times. He makes enough money to cover his basic expenses, but he wants to get more credit to free up money in his budget. Not sure he's a good credit risk at this time, but I would suggest that he revisits his budget and see what expenses he may be able to reduce. And how about this person? Is this person a good credit risk? I'm self-employed and have operated my own pet grooming business for 3 years. My income fluctuates, but I always have been able to cover my expenses. I pay off my business as well as personal credit on time. Okay, that's responsible. And she is paying it off on time every month. I want to get a loan for a new van so I can expand my business for making house calls. I think this is a good credit risk. There's stability in the 3 years. Although her income fluctuates, she's always able to pay her expenses, not just on time, but every month. Let's explore possible consequences of sharing credit or co-signing. Which of the following can affect your credit? Select all answers that are correct. I'll give you a moment. Okay, let's review them together. You co-signed for a car for your brother a few years ago. Your brother has missed car payments. Will this affect your credit? What do you think? You're right. When you co-sign for someone, missed payments show up on your credit report. How about this next scenario? You let your friend use your credit card to pay bills when he was out of work. Oh my, that's unfortunate. But he maxed it out and hasn't paid you back. Will this scenario affect your credit? Right again. You're responsible for paying your credit card, and maxing it out or missing payments will affect your credit score. And how about this last scenario? You took out large student loans to pay for your school. After you graduated, you are deeply in debt. It will take years to pay back the loans. Will this affect your credit? Right again. Having a large amount of debt affects your credit score. You might not be able to qualify for additional credit. Sharing credit or debit. So you're likely to be in a position in the near future in which you may want someone to help you get a loan or establish credit. There's some things that you'll want to consider. Sharing credit or debit with another person is really a big decision, and it really should not be taken lightly. Why do you think someone would need a cosigner for a loan? You're right. Perhaps they don't have enough credit history on their own, or maybe their credit score is too low to qualify on their own. And how about this question? What are some examples of things that you might need someone to cosign for you in the near future? How about a car? Maybe student loans that require a cosigner? Perhaps even an apartment lease, or maybe a credit card. Speaking of credit cards, why would someone share a credit card? Well, I'm sure there are a number of answers that you're thinking about, but also consider this. A parent or a trusted adult might allow a young adult to use his or her credit card to cover emergency expenses, or might co-sign for a credit card to help the young person build credit, right? So that's a scenario or a couple scenarios where there's a trusted, healthy relationship in play, and the parent or the trusted adult is helping the younger person get started building their credit, and or having something to rely upon in case of emergencies. But again, even in this particular scenario, those decisions should not be taken lightly. The consequences of sharing credit or co-signing can really affect you for years. What are the consequences of sharing credit cards? Well, there are several consequences. For instance, when you allow someone to use your credit card, including adding someone as an authorized user, you're responsible for paying the bill. Also, if you go over your credit limit, you may be charged a fee or have your interest rate increase. That's no fun. Basically means that you will automatically begin to pay even more for the items that you purchased over and beyond what they actually cost you to begin with. And how about this consequence? Using too much of your credit limit causes your credit score to drop. So, a good rule of thumb is actually trying your best not to spend more than 10% of your overall credit limit on all lines, all loans. But sometimes you may have to go a little bit higher. But in those instances, just know that the more credit you use on your overall credit limit, your credit score will decrease. How about consequences of co-signing? There are several consequences. When you co-sign for someone, you don't have any right to whatever they bought, but you are responsible for the debt. So say, for instance, at some point, maybe you co-signed for a car loan for your sister. Well, guess what you own? You own the debt. You have responsibility for the debt that's associated with the car, but you don't own the car itself. And how about this? If the borrower doesn't pay, the lender will expect you to pay what is owed, including interest. So let's go back to that car that you co-signed for your sister. If your sister doesn't pay, then the lender will be expecting you to pay, plus the interest, including any late fees. If the co-borrower is late on payments or missed payments altogether, it shows up on your credit report and your credit score will drop. So back to that car instance, your sister doesn't pay, or perhaps she's late, and you co-signed for the loan. Guess whose credit score will drop? Certainly hers, and definitely yours. And then lastly, since you are responsible for the loan, you might not qualify for loans you need for yourself. Be very cautious and very discerning when you're co-signing for others. You wouldn't want to limit your credit opportunities because perhaps you've been a little bit generous in co-signing for other folks. Also, always consider your future, your financial future as well. Okay, I'd like for you to take out your student activity sheets and scroll to the section Sharing Credit Decisions. Now, when you're considering whether to share credit or debt with another person, both of you need to consider the other person's behaviors. Their behaviors around credit, and there's certainly their behaviors in relationships. Now, let's look at these behaviors a little bit here. And while we're doing so, ask yourself, would you be a trustworthy partner in sharing credit or debt with another person as well? So payment history. Is the person making their payments on time? Are you making your payments on time? Well, if you're not, you ought to expose that or disclose that to the person with whom you're considering entering into a credit arrangement with. They'll need to know that. How about amount of money owed? Does the person avoid taking out loans that he or she can't afford? Do you avoid taking out loans that you can't afford? What about length of credit history? Have you maintained credit accounts in good standing over time? Has that person maintained good accounts or good standing of the accounts that they have over time? Regardless of what the answer is, you'll need to discuss that and take it into consideration with the other person. How about ratio of credit available and credit used? Does the person avoid maxing out credit limits? How about you? If either of you are, typically maxing out your credit, that could be an issue for both of you. Even if one of you has a track record of doing so, that will be an issue for both of you if you enter into a credit or debt scenario together. What about relationships? Now, these 4 terms are very familiar to you by now. Honesty, respect, trust, and taking responsibility. These are all things that you'll need to consider before as well as during a shared credit arrangement with someone else. Would someone consider you trustworthy or honest? Do you show and value the respect or the value other person's opinion? You'll need to have a lot of conversation about your spending habits and making sure that you're respecting one another to honor your shared and joint decisions as it relates to your credit. And are you taking responsibility for your decisions and actions? Is he or she doing the same? If not, in the relationship, that could be pretty problematic. But those type of behaviors can also translate into how one manages their credit. So keep that in mind as well. Okay, you decide. Let's get started. I want you to consider each one of these scenarios and decide on the answer to the question. So in this first scenario, this young gentleman says, well, my sister has asked me to co-sign on a loan for her, and I really want to help her, but I'm planning on getting a car myself in the next year. Should I co-sign? What do you think? And while you're thinking about it, also consider this. Even if you trust your sister, and this young guy trusts his sister should make all the payments, having her loan on your credit or his credit could interfere with his or your financial purchases in the future. So, should he? Should you? Things to consider. How about this one? My roommate and I share some expenses, and she wants me to make her an authorized user on my credit card to buy household items. Should I add her? Sounds kind of odd, right? You got a couple of red flags going up too, right? Yeah, well, let's consider some things. And first, I think you should ask yourself, why is your roommate, or why is this young lady's roommate asking when there are other ways to share expenses, right? So is there honesty and equality in this relationship? Seems kind of odd, right? I don't know about you, but I think that she shouldn't add her to her credit card, because it doesn't appear as if that's the best alternative for this young lady, right? Something else is afoot. So have an open conversation with the roommate in this situation, and tell her how you feel and propose other alternatives. What about this situation? You decide. My partner and I are getting serious. We're discussing long-term plans like buying a home together. I have a huge student loan debt to pay off. Should I tell my partner about this? Well, the answer is yes. Because once you or this person marries someone or their partner, their credit history becomes combined. Well, at least in this scenario, even if they don't get married and perhaps they are living in the same household, as implied by partner, they're going to need to understand what amount of available income they're bringing to the household and the relationship to manage their joint expenses. And so this person is bringing a lot of debt to the relationship and needs to share that information with their partner. So let's wrap up. What did we learn? Well, we certainly learned that not all credit is bad, and in some cases, credit can work to your benefit and help you save money. We also learned that people must be really careful about when they choose to use credit, and that it's paramount to pay your debt on time. And a loan or an extension of credit is not based on opinion. There are set criteria, and It's really based on specific criteria and a credit history. And sharing credit or co-signing for a loan with others, it can have long-term effects on your credit score. So you want to be mindful about that. And it can also have an effect on long-term effect on your ability to borrow in the future. So congratulations, you've completed session 4, and we'll see you again next week.